That's the closing bell on Wall Street, and now it's market domination overtime. Jared Blicker going to be along in a moment to give us the details from today's session. I'm going to start with where the major averages ended the day, and that is higher across the board, which was not a given at various points during the session. We did see in particular the NASDAQ kind of flirting with negative. We had some data this morning, economic data, that wasn't great. Confidence among home builders falling here. Retail sales coming in with a smaller gain than had been estimated. Manufacturing in the New York region also showing a slump. All of that said, stocks stabilizing and moving higher here for the second straight session. The Dow up by 353 points, up about 0.9%. The S&P up almost 2/3%. And the NASDAQ, which, as I mentioned, kind of struggled here midday with a lot of the mega cap tech stocks not doing well, then largely recovering. We're recovering to some degree by the end of the day with 1/3% gain. Jared's got a closer look now at today's action. Hey, Jared.
Thank you, Julie. Today, let me just bring it back to Friday. This is the best two-day stretch that we've seen since just after the election. So you got to go back to that November 6th, November 7th rally that we had. And that was substantial at the time. So this is substantial as well. And it's nice because it comes, the prior 3 Mondays have all been down days. 2 of them have been really bad. And Julie, you and I are going to talk about this more in about 30 minutes. But you go down the line here and we're seeing some positive returns, which is a change from recent history, at least over the last 2 days. Here's the VIX. VIX is coming down too, still holding over 20 right there, but I'll show you the year to date so you can see it has come down from almost 30 up there. So that's a nice movement, relieving, taking some pressure off. And we can also see in the bond volatility, that has come off of its high as well. And let's take a look at the 10-year T-note yield. That is down just a fraction of 1 basis point, so basically unchanged there. U.S. dollar index down about 1/3%, and that is flirting with the lows of the year. So that's something that we want to monitor. If it drops too quickly, sometimes that's not always risk on, but generally a lower dollar is supportive of risk assets. And let's get here to our sector action, and I'm going to put this on an intraday basis. There we go. All 11 sectors in the green here, led by real estate. So the interest rate sensitive sector was first, even though we didn't have much going on with rates. Energy second, then staples, then industrials. So a pretty healthy mix here, interesting mix. And if we take a look at the NASDAQ 100 and the NASDAQ, kind of the laggard of the day, you can see some of the weakness that Julie was talking about in here. Tesla down almost 5%. And then a lot of these mega caps, not down a lot, but enough to tilt things. And let's finally leave this on the Dow here. Aside from a couple big ones and American Express, we're seeing a lot of green here, just kind of illustrating that today was more bullish than bearish.
All right. Indeed it was for the second straight day. Thanks a lot, Jared. Well, investors are hearing a lot these days from Trump economic officials about trade and Doge and the benefits of falling stock prices, but not as much about things that could stop that selling. Joining us now with more, Yahoo Finance's Ben Worschel. Ben, we keep framing it a lot, or we hear a lot of policy wonks sort of frame it as we're getting the vegetables and then eventually we'll get the dessert. But man, that dessert is sort of a moving target, isn't it?
For sure, yeah. The question is increasingly not only are we going to get the dessert, but when are we going to get the dessert, and is the dessert going to actually be that good when it gets here? Yeah, I mean, so the overall message from the Trump team for weeks and months now has been this mix. It's you kind of take the good with the bad from a market's perspective. You get the tariffs, but you also get deregulation. You get to the Doge cuts, which may cause a little chaos, but you get tax cuts in part of it. And part of what we've seen in recent weeks is that taxes are not only being downplayed, but they're often sort of not even mentioned as much anymore. And that's partly a reflection of how little news there's been on taxes. Congress moves much more slowly than the president can, especially on tariffs. Congress is out for the coming weeks, so we're not even going to expect to get a whole lot more there. And then there's been this sort of flurry of tariff news from Trump over every week on it. And then we have an April 2nd deadline coming up for reciprocal tariffs, and that's expected to kind of dominate the conversation for another 2 weeks without a lot expected on tariffs. Trump's line today I wanted to bring you was that his line is that April 2nd is going to be Liberation Day for our country on tariffs. So he's definitely focused on this tariff side of it. The question is when he pivots to taxes and what that actually looks like for markets.
And as you know, Ben, I've been asking a lot of investors, what happens if that pivot doesn't happen, right? What happens if there isn't this big bill that includes an extension and or maybe more than an extension of tax cuts. And investors first of all, don't even really seem to be considering the possibility that it wouldn't happen. But they do say if it doesn't happen, it will be bad, right?
Yeah.
Sort of unequivocally.
For sure, yeah. There's analysts out there that have this as an 80% chance of a bill happening, which 20% not happening. That's a 1 in 5 chance that we actually don't have a bill at the end of the year, just because this tax stuff is so complicated. There's so many issues in there, and then the costs are so high that it's unclear exactly how Washington is able to justify this with a $36 trillion current debt. Some of these numbers we're talking about is an additional $10 trillion in debt on the GDP, and so what we're left with is lawmakers grinding through this really slow process, trying to figure out a way to extend these and add things like no tax on tips, no tax on Social Security that Trump is really focused on. But it's going to be a long slog, and it could be kind of one of these things where we don't know till December, and even that uncertainty makes markets unhappy for certain.
Yes, we have seen lots of evidence of that this year thus far. Ben, thank you.
Talk to you later.
Let's talk more about the market outlook here. Joining me now is Scott Ladner, Horizon Investments Chief Investment Officer. Scott, it feels like the theme of the show so far, which you've written about, is that we're sort of in this wait and see economy right now. We're waiting to see which tariffs are going to stick and what effect they will have. We're waiting to see if we're going to get a tax cut or even an extension, to Ben's point. How do you invest in a wait-and-see economy?
Well, I mean, hopefully, Julie, you don't actually wait and see. We have to make decisions today about some of this stuff in the absence of a lot of facts. And that absence of a lot of facts is making people very uncomfortable.
Yeah.
And so it's not only investors that are uncomfortable, but it is consumers are clearly uncomfortable, as we've seen with some of these surveys. Business leaders are uncomfortable because CapEx plans are coming in. So, unfortunately, the wait-and-see outlook isn't great. Now, this is a completely man-made wait and see. I mean, this has been sort of man-made uncertainty injected into the system. It can just as easily be uninjected or taken out of the system. So I don't think that's quite in the price right now. But the problem with the wait and see economy is that if everybody decides at the same time just to stop, because I don't know what's going to happen next, that's a recession. That's how you get a recession. Now, to be clear, that is not what we think is going to happen. But that is the risk out there that if this thing goes on long enough and there's enough uncertainty that persists for long enough, people are just like, okay, we'll just wait.
Well, either that or people learn to make do with the uncertainty, right? Which is also, people adapt. In other words, companies adapt, which is a thing that tends to happen also, right?
Yeah, look, we are very resilient. The economy is really resilient, and consumers are really resilient, and investors are very resilient. And so, yes, we will figure it out. But the process we've been going through over the last month or so has been people figuring out, hey, listen, we don't have necessarily a pragmatist in office this time. We had a pragmatist, much more of a pragmatist last go around. This time we got somebody that's much more driven by ideology, much more driven by things he wants to get done quickly. And that sort of transition from hey, he's got our back no matter what, from an investment standpoint. He's got our back no matter what. Stock market goes down, he's going to pull the plans, and he's going to change, and so on and so forth. He's not doing that right now, right? And so that transition from realizing that we don't have this, somebody's necessarily got your back immediately, to something else is that's what I think that's part of this the process of being adapted.
Well, and to your point, maybe, either he was a pragmatist, now he's not, or there were pragmatists around him, right? I think that there was this assumption that Scott Besson is a former hedge fund manager. This is the guy who's going to be the Treasury Secretary. Howard Lutnick runs a bank, right? An investment bank, basically, a brokerage. So, how does that, where do you think we are in that realization process on the part of market participants?
I think we're a lot of the way through it. I think at this point nobody's surprised that we don't necessarily have clarity and certainty right now, because Trump is using some of this tariff policy to prosecute a lot of his objectives, frankly. And Besson has been pretty clear, and especially just this weekend, saying, listen, we view a correction, we view this sort of market action that we've been seeing as healthy. It's not healthy when you go straight up and you get euphoria. Now, we weren't getting euphoria anytime soon, but so he's got to sort of say some of this stuff. But I do think if things get particularly bad, we are in kind of an animal spirits type of economy. If the market goes down too much, that will end up hampering Trump's plans, and that won't be good. But right now, a 10% correction, by the way, which feels much worse to folks right now. A 10% correction is very sort of manageable. You get, if we start getting towards the 20 or 25 or 30%, all bets are off with some of the stuff. But we just don't think we're going to get there because the economy is just too darn strong.
So you're not doing wait and see investing because you don't really have the choice of doing that. So what are you doing right now then while all this is going on?
So we've been moving money actually out of the U.S. and more into places like Europe and emerging markets, places that were sort of verboten from an investment standpoint because they just didn't have their fiscal house in order, their regulatory house in order, or otherwise. But Trump, frankly, looks like he's scared the bejesus into some of these countries and into some of these officials by some of these actions. So he's kind of scared other countries into action, whereas like people like he's scared Americans into inaction, but he's scared other countries into actually doing a lot of fiscal expansion, especially in Europe. First time we've seen that in what, a generation, and he's forcing China to think about maybe coming off of common prosperity. And maybe even doing a little bit of fiscal, we'll see. But the threat of Trump has gotten some of these other economies and some of these other geographies kind of off their hind legs and getting to move again. So that's actually unlocking some investment potential for the first time in a very long time outside the U.S. So the primary thing we've been doing is moving money out of sort of the cyclical value U.S. side and moving it, which we still love tech, and moving it more into more into frankly Europe and emerging markets types of places, at least for a while.
Okay, so I have two follow-up questions then on that. First of all, we've already seen a big run in parts of Europe, for example, and in things like K-Web, the Chinese internet stocks, right? So how much more do you think can we see on top of what we've already seen?
It will depend on somewhat on some of if the policies actually get followed through. So the move we've gotten so far in both of those places has been more speculative, like, oh my gosh, fiscal expansion is possible in Europe. Now the next thing is we actually have to see it happen, and we've got to see it flow through some of the company results and see consumers actually get excited over there again and get off their hind legs. In China, it's going to be, is she really coming off of capitalism as evil? And is he really coming off of common prosperity? Now, we've seen it before in China where like one day it was zero COVID, the next day it was not. So he can change his mind and move 180 on an issue, on a very big issue, before, like pretty easily. He may be doing it again on this common prosperity, anti-capitalism thing. If that is the case, like China's all of a sudden investable again. It's the second biggest economy in the world. And Europe, again, these aren't, I don't think, long-term trades because American exceptionalism is still there. It's probably still going to rule the day. AI is still him. But these other places are all of a sudden much more investable than they have been for a very long time. And so that's seeing how it actually comes through in reality is like outside of the initial burst of like, oh my gosh, this is possible. Like that's sort of the next leg of this.
Okay, so let's come back to you love tech. You still love tech.
Yep.
US mega cap tech specifically?
Anything touching AI. So just like anything touching PC or internet 25 years ago, 30 years ago, was you couldn't, like, you may be wrong for a little while, you're not going to be wrong over the next 3 or 4 years. That's kind of how we feel about US tech today. And so especially as it has been obviously bludgeoned over the last month or two. So these are much more attractive prices to get in than it was a month or two ago. And so yes, we want to continue to add into weakness in that space because we think that trend and that tailwind is not going anywhere soon.
Scott, thank you so much for coming in. It's
Thanks,
good to see you.
Likewise.
Appreciate it. Up next, we're looking at trends within the shipping industry and what they say about the risk of an economic slowdown. More market domination overtime coming up. President Trump's tariffs are reshaping global trade, and businesses and consumers alike are feeling the ripple effects of supply chain disruption. For more, we're bringing in Ryan Peterson, founder and CEO of Flexport. Ryan, it's good to see you. Of course, we have checked in with you on supply chain health ever since the pandemic. And some of the numbers that we have seen have shown this sort of increase in ordering as people try to get ahead, as companies try to get ahead of the tariffs. I'm curious what you're seeing on that front in your business.
Yeah, we saw quite a bit of that in Q4, especially once the election happened. But, these supply chains take a long time to move goods, especially if it's ocean freight. So you saw some acceleration of air freight coming in. But at this point, we expect the tariffs have already started to go up and expecting it to go up even more by April 1st, which is when the U.S. Treasury Secretary has to issue his report summarizing what they call unfair trade practices from China. So we would expect higher tariffs then. But I mean, April 1st is around the corner. So I don't think there's a lot of time left to front load.
No, it doesn't. The clock is ticking for sure, Ryan. So what kind of changes have you been seeing? What kind of patterns have you been seeing, whether it's geographic patterns or patterns of particular goods that have changed as people have sort of battened down the hatches getting ready for this?
Yeah, well, so Flexport's one of the largest providers of air and ocean freight, and one of the largest customs brokerages in the United States. So we see it all basically. What we've seen for a long time is people shifting supply chains out of China and moving sometimes out of China altogether. A lot of it is what you call China plus one, moving parts of this supply chain. Vietnam's been the big beneficiary, but right now what's happened, especially with the tariffs that have hit briefly Mexico, but actually have been implemented against Canada, is that people now feel a little bit of paralysis because there's if Canada is subject to higher duties and the European Union seems to like it's coming down the pipeline, then you can't really feel that Vietnam or Malaysia or India are safe havens against duties. So people feel a little bit of paralysis, a little bit of wait and see. Let's see when the next shoe is going to drop, where those duties are going to land before, supply chains are long-term footprint. So you don't really want to make long-term investments if it's uncertain what the landscape's going to look like even a few months from now.
Yeah, and I guess layer on all the tariff uncertainty, maybe some consumer uncertainty too, because they're watching all the tariff headlines, economic headlines, and there are all these concerns now bubbling up about consumer spending. How is that? I mean, is it sort of, in your view, is it sort of difficult to separate out from the tariff uncertainty when it comes to what companies are doing?
It's a little bit difficult. I mean, we've got some companies that are being hit with higher duties, as much as 50, 60%, in some case higher than it was this time last year for certain products. And so there's no world in which the companies can just absorb that cost. They're going to have to pass it through to consumers in the form of higher prices. And now, big open question for a lot of categories of goods is, do consumers keep buying? And is demand get diminished? It's a little too early to say on that front, but for certain categories that are kind of not must-haves, you would think that spend will shift onto other categories. And America is relatively resistant against this. We import less as a percentage of our GDP than almost any developing world country. We're self-sufficient in food and energy, and there's a big hype around trade and imports from China and stuff, but the reality is we depend less on trade than almost any country in the world. So it's not that all prices are going to go up for everything, but for certain categories they will.
I also was reading a little bit that we are seeing container rates going down. In other words, ocean shipping rates going down. Is that a reflection too of all of these elements that you're talking about?
Some of that, but actually the bigger factor in ocean rates coming down is there's just been a lot of new capacity coming online. These ocean carriers, the ones that own and operate the ships, made major investments after the pandemic. They made a lot of money during the pandemic, and they reinvested most of that in new fleets, and those are in new ships. And so that fleet is coming online. We've had a big increase in the number of container ships in the world and the size and capacity of those ships. So as those come online, that brings down the price. The big driver, the big unknown in that is the new action we see in the Red Sea to try to reopen that major maritime choke point that's been cut off since the end of 2023 with the actions of the Houthi, the terrorist movement down in Yemen. And so if the Trump administration is successful there, you could see ocean freight prices come way back down, but we're pretty far off from the ocean carriers feeling like it's safe to return to the Red Sea.
Gotcha. That's interesting. I also want to ask you about another proposal coming from the administration. That's not a tariff proposal. It's a fine, apparently, and it has to do with U.S. Goods being shipped on U.S.-made vessels. I believe the comment period for this is open for another week or so. It's unclear if this is going to go into effect. But what kind of effect would that have on the shipping industry as well, if it did?
Yeah, so the U.S. Trade Representative's Office has given until the 24th of this month, until next week, for public comment. So you can still get your word in there. And the proposed rules have a few things in there. One is that companies that have any Chinese-made ships in their fleet or in the order book that have ordered ships will be charged up to $1.5 million per port call, and when they come to the United States, for all the ships in their fleet, not just for the Chinese-made ones. And so that's every ocean carrier has at least one Chinese-made ship in their fleet. That's going to have a big impact in that today these ships will make 3 port calls as they on each coast. They tend to call on the West Coast, for example, in Seattle, then in Oakland, and then in LA. What the carriers are telling us is, hey, if this gets put in, they're likely to divert and just only make 1 port call in LA. So that would have a big impact on some of the secondary ports in our country. And then the second thing is what you said, is that there's a clause in this proposal that says that within 7 years, no more than 15% of American exports can travel on a foreign-made ship. That 15% must travel on a ship that's made in America. The U.S. really doesn't produce a lot of container ships. The ones that we do produce are really small, and they're basically just going to Hawaii, Alaska, Puerto Rico, to domestic ocean freight. So that's going to be, if that goes through, would be a real limiter on U.S. exports, which seems counter to the actual spirit of the administration's work here, which is to try to promote U.S. manufacturing.
Right.
So hopefully that gets revised during this comment period. But if you're an American exporter, American manufacturer, they'd love to hear from you. I think you have an opportunity to go submit your opinion to the U.S. Trade Representative. They're asking for that for another week.
Right. Ryan, I want to put all this together. Bottom line, as I said, we've been talking to you since the pandemic about the resilience of the supply chain in the U.S., but also globally. Given some of these shocks we're talking about, how resilient are we? I mean, are people going to see interruptions for goods because of some of the dynamics we're talking about, or are things okay?
Well, I don't think in the physical world, physical logistics, we've made much progress in the world. If anything, we may have stepped back. The unions have negotiated to put a pause on all automation of ports in the United States. Companies are still focused as ever on reducing working capital, which means less inventory in their network, which means you're less ready for a supply chain stock. So I think that nothing's changed there. The one positive force has been technology, and that you've seen massive increases in the visibility that companies have, thanks to companies like mine and others that provide real-time visibility on all the goods that are moving down to the item level. So helping companies do better planning, know where stuff is, respond to shocks. And then the rise of AI, we're seeing massive improvements in the ability to do things like route optimization, planning, getting people data at their fingertips. So I think there is a positive momentum swing in technology that probably brings down costs and certainly brings up levels of visibility and control for companies' supply chains.
Ryan, good to see you. Thanks so much. Retail sales rising less than expected in February, signaling trouble for the U.S. consumer and on the part of the U.S. consumer. It comes after recent reports showing small business optimism receded in February. That's according to the National Federation of Independent Business. Here with more on what's weighing on small business is Elizabeth Gore, co-founder of Hello Alice and host of Yahoo Finance's upcoming podcast, The Big Idea. Elizabeth, it's good to see you here. So we've been hearing all these sentiment indicators. The small businesses that you're talking to, what are they most worried about right now?
Well, howdy, thanks for having me. Yeah, it's almost like my tween kids, right? They're happy one day, sad the next. Oh my goodness. We had some optimism coming into the year and now it has gone down. And everything comes down to core unit costs. So whatever is going to raise costs for a small business owner is going to get them concerned. The threat of tariffs, that is going to raise unit costs. The fact that interest rates are not going to go down right now. The fact that we are not seeing capital go down in its cost to access loans, credit, and grants, that's got everyone concerned.
And how is this going to affect existing small business versus, say, small business creation?
Well, it's interesting. If you look at existing small businesses, they're just as affected because they're looking at, again, what is their supply chain they're having to purchase constantly? If you look at food services, if you look at construction, they're buying the same goods week over week. And if those costs are going up, it's a concern. On the flip side, if you look at a net new business, let's stay in food services, they're going to have to buy electronics. They're going to have to buy that oven. So they're buying larger purchases. Again, that's higher costs. So both those are being impacted right now. I will say for those who have been around for a while, being really resilient, being really smart about your cash flow and a bit more conservative than normal is important right now.
I also wanted to ask about some of the federal budget cuts that we've been seeing from the new administration. I think of the Small Business Administration, for example, and its interplay with small business in the U.S. So what kind of effects are you starting to see, if at all, or what are people worried about and talking about?
Well, big thing that people don't discuss every day are supply chain, supplier diversity contracting. If you look at the billions federal government spends with small and medium businesses on everything from supply chain to food services to consulting contracts, we are seeing those either stop, freeze, or go away. That is a big amount of money for small and medium businesses. The other one is grants. So grants that come out of the federal government that have stopped or been frozen for small business, whether it's coming out of the SBA or it's coming out of departments, those are other areas that folks are concerned they're not seeing that cash flow.
Elizabeth, good to see you. Thanks a lot.
Thanks.
Well, for more on navigating the world of small business, be sure to catch Yahoo Finance's upcoming podcast, The Big Idea, hosted by Elizabeth Gore. It will premiere April 24th at noon Eastern. We'll check out shares of Alphabet in after-hours trading. The Wall Street Journal reporting the company is closing in on a deal to acquire cybersecurity company Wiz for about $30 billion. That is higher than a previously reported bid over the summer for about $23 billion. Those talks at that time fell apart, partly over regulatory concerns and whether a deal would be cleared. Any deal now would have to be approved, but it would be one of the largest so far this year. And after a lot of hopes that this administration would be more amenable to these types of deals, it is still an open question if they would. So this will be a closely watched situation. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend. I got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.